We'll continue into the investing area on the statement of cash flow. And in our place, the examples that we've provided so far, it's very simple. We only have two accounts on the balance sheet that we have a provision for investment, and that is the time deposit and the certificate of deposit. In an actual operation, we probably have provisions for additional property, plant, and equipment. We could buy additional chairs. We could buy additional kitchen equipment. That would change the balance sheet, and it would involve an investment in additional property, plant, and equipment, which could affect the statement of cash flow. But at our place, in order to demonstrate this at a less abstract or a more direct approach, we're going to limit our investing activity to the time deposit and the certificate of deposit. The time deposit balance at the beginning of the period was $12,500. We note at the end of the period it is unchanged. It is $12,500. So there is no impact on cash flow. The money is still available to us, but it's tied up in the time deposit account. We have the provision for a certificate of deposit at our place, which earns more interest than the time deposit does. We had no balance at the beginning of the period. We have no balance at the end of the period. So the net effect on investing cash flow is zero. There's been no change to cash as a consequence of the time deposit and the certificate of deposit. We're down to the third area of the statement of cash flow, which is the financing activity. The note payable. We had a balance of $30,000 on the note at the beginning of the period, and a review of the balance sheet demonstrates that the ending balance is exactly the same. No payment was made on the note during the course of the first period, so there was no effect on cash flow. I'm going to skip the line of credit for a minute and come back to that after we make our remaining financing entries. We know that the total mortgage at the beginning of the period was $305,000. By summing the current portion of the mortgage and the long-term portion of the mortgage at the end of the first period, we discover that the balance of the mortgage is $300,929. The principal has been reduced by $4,071. Again, the mortgage is a liability account. It declined in value over the quarter, which represents a cash outflow, $4,071. Now recall, going into this section, our operating cash flow is negative $22,997, and yet we still have obligations we must pay, the mortgage and the lease respectively. So you're starting to understand where are these shortfall in cash coming from, and it's going to be coming from the line of credit. The total lease, $80,000 at the beginning of the period. As we did with the mortgage, we add the current portion to the long-term portion at the end of the period, and we discover that the ending balance on the lease is $78,399. Again, the lease is a liability account. It declined in value over the course of the quarter in the amount of $1,601. Capital in excess of par, there was no change. $50,000 at the beginning, $50,000 at the end. No change on cash flow. It would be possible to go back to the shareholders to borrow additional capital, in which case that account would have increased in value, a source of cash. Or over time, we may return that temporary contribution of theirs, capital in excess of par, and that would represent a cash outflow. Recall that we are a corporation, and there is a provision for dividends to be paid in a corporation. And it's not known to us at this time whether dividends were paid or not. However, there's one simple test that we could perform to determine if in fact they had. And the way to do that is to audit or compare the net income after tax for the first quarter to the retained earnings account on the balance sheet. And in so doing, you note that the net income was negative $9,807, and the retained earnings account is also negative $9,807. The retained earnings / deficit account is the account where the profits accumulate over time until such point that a dividend is paid. And the value of the retained earnings account is decreased by the amount of any dividend payment. However, certain rules apply to being able to legally pay dividends in a corporation, and those tests would have to be verified prior to any dividend payout. But we'll leave it at this point to suggest that no dividend was paid and leave the three rules for dividend payments for another time. So we're going to enter 0 for the dividends paid, has no effect on cash, and before we enter the line of credit account balance at the end of the period, we see that our total cash flow is negative $28,669. Not very good. And our cash on hand at the beginning of the period was only $6,500, some of which was available to us to put towards those outflows of $28,000, but clearly not sufficient to cover the total amount. So what kept us in business? The line of credit. So if we look at the line of credit ending balance at the end of the first period, we find that the line of credit balance was $25,319. It's a liability account. It was 0 at the beginning of the quarter. It's $25,319 at the end of the quarter. It was a source of cash, fortunately for our place. That entry to the statement of cash flow demonstrates that the cash flow from financing activity was a positive $19,647. That when added to the investing cash flow of 0 and the operating cash flow of negative $22,997 produced a total cash flow of negative $3,350. Now, the way we can audit that is by taking a look at the cash balance at the end of the quarter. We started the quarter with a cash balance of $6,500. A review of the closing balance sheet shows the ending account balance is $3,150. The change in cash is $3,350, exactly equal to the amount of the cash outflow that is demonstrated by our statement of cash flow. The statement of cash flow is viewed by many people in business to probably be the most important of the three financial statements that we've discussed today. The values to create it, however, do come from the other two, statement of income and the balance sheet. Well, what lesson did we learn by constructing the statement of cash flow? Well, our place really suffered from a lack of working capital. And one way that we could have analyzed that at the beginning of our presentation on the balance sheet would to have been to look at the current ratio on opening day. If we were to review the current assets to the current liabilities on opening day, you'd find that we had significantly fewer current assets than current liabilities. Recall, current liabilities are those obligations that are due and payable in the upcoming 12 months. And it's critical for businesses to be prepared to meet those current obligations or to be sure that they have access to cash, such as the line of credit, in order to do so in periods when they cannot generate it from operations. Many financial accounting books will suggest that a current ratio to provide adequate safety in business ought to be a value of 1, meaning that if we divided the current assets by the current liabilities, we would calculate a value of 1. There's $1 of current asset for every $1 of current liability. The coverage requirements, however, for working capital do vary from industry to industry. And the restaurant industry, fortunately, happens to be an industry where we generate cash on a daily basis. That's in contrast to a large manufacturing company that may have a huge investment in materials inventory, processing inventory, and finished goods inventory, and may only sell goods that are seasonal. For example, snow blowers in North America. They may take 9 months over the course of the year to manufacture an inventory that's adequate to supply all of the organizations to whom they sell. And yet they may only generate revenues during a 2-month period of the year when that inventory is actually shipped and they receive payment for it. The manufacturing industry has a very different working capital requirement than does the restaurant industry in that example. However, that's not to suggest that the working capital at our place really was adequate for opening quarter, and it really was not. But like many of the small independent businesses, their access to additional capital was severely constrained, and that was the best that they could do. Fortunately, the access to additional capital when it was needed through the line of credit was critical for the future livelihood of this particular establishment. So at our place, the line of credit provided the survival. It was really the life vest, if you will, at our place in that first quarter because of the significant shortage of cash flow from operations. It was inadequate to meet the financing outflows. So our place must begin to generate cash flow from operations in order to cover its financing obligations in the future. Remember, those financing obligations are the promises that we made to those people from whom we borrowed funds.